all of our guests would know. A lot of our guests will be able to relate to that, Sandhya, and it's very inspiring too. A little bit about Sandhya. She has been a Dallas resident for nearly 30 years now. She is an experienced hands-on multifamily investor, syndicator, and asset manager. Owns 3,000 plus doors as a limited and general partner. She holds a bachelor's and master's in electrical engineering, as well as an MBA. Hats off, Sandhya. She's also the founder of Engineered Capital. Great, great. And Sandhya's extensive knowledge and experience in engineering, management, and metrics-focused investment decisions has enabled so many to take control of their financial future. So Sandhya, thank you again so much for your time. We truly appreciated you coming on a holiday. And without further ado, Sandhya, let us dive in. Give us some insight into your journey, the market conditions, why it's great to be a passive investor. So I'll let you take it from here. Thank you, Sandhya.
Thank you so much. If someone could allow me to share screen, I would appreciate that. And so I moved to the country about 32 years ago, came straight to Dallas with 2 suitcases in hand, like many immigrants, and came here because I had a scholarship to attend SMU. My parents made about $50, $60 per month in salary. I wasn't going to pay for $20K a year in tuition at SMU. So obviously I needed a scholarship and a little borrowed money to come here. Got my electrical engineering degree, got employed right away at Texas Instruments in Dallas, after which, while I was working there, I realized that all the business folks make all the decisions. So I got a part-time MBA while working full-time for them, which also my company paid for. So I got my business and financial knowledge from that, which helped me do financial analysis and grow on the business side, in addition to the technical side within the company, and form a lot of investor clubs, join with other MBA friends, and start actively trading in the stock market, options first, because I didn't have a lot of cash, and then actual stock. So when I had children, I went full-time into the stock market, and I was completely trading stocks 2 to 3 hours a day, and the rest of the day was open to spend with my children. I stumbled upon multifamily by attending a weekend event by Brad Sumrock, who's the mentor for Herb and Nikki and several of us here. And what I found out, well, I was looking for something to save on taxes, and multifamily seemed the way to go because I didn't have a handy person background to be able to do the tenants, toilets, trash, and termites kind of stuff that a landlord has to do. And when I looked at the margins for single family by trying to employ a property management company, there just wasn't much margin there. I certainly wasn't going to do a fix and flip. So I went straight to doing multifamily, large multifamily. I had my retirement money from my previous employer saved, with which I was able to do some passive investments. And that basically helped me with getting into multifamily, first as a passive investor, and then as an active syndicator by partnering with people within the group. So are you able to see my screen where I'm talking about, real estate syndication and what the heck it is?
Yes, we can see it.
Great. So now I'm going to click and hopefully it'll change. So what is a real estate syndication? Many of you know it. Basically, we're talking about buying large $25 million kind of properties, and none of us have the individuals have the money to go buy it ourselves typically. So what we do is we get the money sourced from a lender like Fannie or Freddie for 70% of the deal, and the remaining money to put down as a down payment is done through a pool of investors. We all pull together and buy a large property that we can't buy on our own. So limited partners or passive investors contribute the money, but they don't make any of the decisions. They are very similar to what I call passengers in a plane. So they're very passive. Once they buy their airline ticket, they sit back, relax, and enjoy the ride. And the co-pilot and pilot, who are the general partnership team, are the decision makers. And so the general partners are responsible for doing everything to execute the business plan. This is very similar to the stock market. If you and I go buy Amazon stock, we're just like passengers in a plane or passive investors, while the executives at Amazon make all the decisions, and we hope they make good decisions so that our stock price appreciates in value. So very similar. So all of us basically are passive investors, because I think whether you like it or not, if you ever had a job, your employer probably put some money into a 401k plan, which has stocks and mutual funds in it. So what I tried to do was also to create passive income, which is what Warren Buffett says, is if you don't find a way to make money while you sleep, you're going to work until you die. So how do you make that a reality? By having enough of a passive income stream. And you want to define what that number is. And for me to start with, that was about $10,000 a month. So what do I have to do to earn that income so that I don't have to work and my husband doesn't have to work unless he really loves it and unless I really love it? So that was sort of our initial plan. So what is passive investment, right? You basically contribute money to a deal, make sure you do a good job of vetting the sponsorship team, and the money is working for you, whether you're at the beach or you're asleep, right? The money is still making money for you. The difference between that versus earned income is you show up to work, you get paid. You don't show up to work, you don't get paid. So that's where you're trading your time for money, which is earned income. Passive income is what we call mailbox money, which basically comes as an ACH deposit into your bank account. So ultimate goal, at least for me, is to have passive income to where I don't have to work unless I really want to. So the biggest thing I would say as a passive investor is figure out what your goals are. I know for me, the biggest goal was always capital preservation. No matter what, I don't want to lose my money, right? That's rule. If you ask Warren Buffett, that's what he's going to tell you. Rule number one is what? Don't lose money. Rule number two, don't forget rule number one. So preserving your capital is the most important thing. The second one is you want to have some form of equity growth. So the equity growth could come from market appreciation because you picked a good market when it comes to things like real estate. You want to have forced depreciation, meaning beyond just waiting for the market to appreciate the value of your property, you want to be able to force that. And then you want to have the benefit of leverage, right? So when you buy stock, you could buy it as options. So you're not really paying the full price for everything, right? So like I said, and when you buy a single family home, when you buy apartments, you're only paying a down payment. Most of the loan is funded by a bigger lender, whether it's your bank or your Fannies and Freddies. So you want to make sure you find an asset that takes advantage of leverage. You also want to have something that gives you tax benefits. So the stock market never gave me any tax benefit. So even the people who believe that we should pay as much taxes as we can, they all have retirement funds and they're trying to pay less in taxes, right? So we always want to find something that gives us tax benefits and is a hedge against inflation. And you want to make sure there's enough reserves in that investment to where when there is a bad tiding that you don't have what we call as a capital call, where you have to put more money of capital into it. So these are some of the goals you want to have when you choose an investment vehicle. You really want to know what is your risk tolerance, right? If you're planning, most of these syndications require $50,000 as a minimum investment. So if that's your last 50K, you don't want to put it into a syndication and be left with nothing else, because especially in real estate syndications, it's pretty illiquid, right? You don't get your money back for 5 years. You don't know exactly when the capital will come. There's a lot of projections made at the beginning by the sponsorship team, but as market conditions change, like the interest rates, they increased quite a bit last year that nobody predicted, it could change. So you want to see how you can get the best risk-adjusted returns for your investment. And how do you reduce your risk and still find a really good deal, right? And that's where the education comes in. So how do the returns work, right, in a typical investment? This is an example from a past deal I had where you'll be presented with an investment summary much like this. It says 118% total return, right? And then it says 65% leverage. So the leverage they're talking about here is about the loan itself they're applying for. Then there's cash flow. That's an average annual cash flow, right? So you're not guaranteed any of these numbers. These are all projections of how the sponsorship team expects the deal to perform. You'll be shown an investment summary much like this, and the team will dive into all the details. So you want to see if all these numbers seem acceptable to you at the beginning. So bonus depreciation, what is that? That's where the tax savings come in. But you want to talk to your accountant to see if you are going to be able to use those savings. In some cases, you may have to be a qualified real estate professional. But 68% bonus depreciation means that if you invest 100K, you will get about 68K as a negative K1 loss for that calendar year, like 2022, if you made this investment. They also usually give you a summary of what kind of debt they're taking on. Some people are a little bit leery of floating rate loans. So emphasizing that it's a fixed rate loan might make the investors feel less concerned about the deal. This is, again, just an example of a past deal, but here's an example 100K investment where they show you what your cash flow may look like for the 5-year hold period. So if you look at the bottom row here, if you put 100K in the first year, you only get about 4% or $4,100 and so on. So it averages to that 7%, but year one, when they're trying to stabilize the deal, the cash flow is actually pretty low. So you really want to pay close attention to this cash flow number and see if that meets the cash flow that you require, right, before you make that investment. And at the time of sale, they're expecting quite a bit of appreciation in equity. And that's why they're saying the total return on 100K becomes 218K. And again, it's an example of a past hold deal. One other question I always get asked by investors is, how does apartment investing compare to single family? Why can't I just go buy a single family rental property down the street and it's all my own? I don't have to give up control. I don't have to invest in something that I don't fully, have control over, etc. So one of the things I like to compare is, what is the difference, right? So in an apartment complex, it's basically a business entity. So its value is based on net operating income, versus in single family, its value is based on the price per square foot in that neighborhood, right? I think most of us understand that. Like in Dallas, there's an area called Highland Park, which is very fancy, which is right by the college I went to, SMU, where the price per square foot is quite a bit higher than, say, a suburb like Irving or Carrollton or South Dallas, as an example. So you don't get to influence the price of your single family home, even if you fill it with marble floors, et cetera, and make it look like a palace, right? This is the price per square foot in that location. In multifamily, because it's a business, we get to force appreciate the value. So you could have two apartment complexes right next door to each other. And let's say I'm operating the one here, and I'm going to operate it more efficiently than the one next door. By increasing the revenue, which is mainly the rent and other income sources like parking or Wi-Fi, et cetera, the total income goes up. And I can reduce my expenses by doing things like water conservation, maybe LED upgrades, and other ways to control my expenses. Then the difference, right, revenue minus operating expenses, that's your net operating income. So if my net operating income goes up, I'm able to force appreciate the value of the property, because NOI, or net operating income, divided by the cap rate is what determines the price or value of a property. That's why this is a business for which you could force appreciate its value. And that's something you can't do in single family. It's kind of fixed and is sort of determined by the market conditions there. You don't really get to influence it. The other big reason I like large apartments is because you have the economies of scale. So you could afford to employ a third-party property management company, and you don't have to worry about the 4 T's: tenants, toilets, trash, and termites. You still with me? You're still with me and you're kind of awake. Type in the chat box. Why is an apartment complex different in its valuation compared to a single family?
Yeah, guys, don't forget to ask any question, because the winner is the best question, whoever is gonna ask is gonna get the winning gift.
So, you don't have these economies of scale when you only have one tenant, one door at a time on a single family or even a duplex, right? If one tenant doesn't pay, your rent's gonna go down from 100% to 0 or down to 50%. In multifamily, I buy like 100+ door properties. That's what most of the other syndicators on this call also do. So even if 1 or 2 tenants don't pay the rent for whatever reason, or the apartments are vacant and not collecting any rent, we underwrite it. We plan for what we call economic occupancy, which is different from physical occupancy. So physical occupancy is if I have 100 doors and I have 90 occupied, I'm at a 90% physical occupancy. But if 5 of those tenants don't pay my rent, then I'm at 85% economic occupancy. And so I can underwrite my deal for that economic occupancy number when I plan for it. So even if a few tenants don't pay, I'm okay because I have the economies of scale. The other reason I like apartment investing is because we sign what we call non-recourse loans with Fannie and Freddie. So for any reason, if we can't pay the mortgage, we go into what's called forbearance, but they don't come after our personal property. They go after the asset. So that's why it makes it non-recourse. Whereas if I have a bank loan mortgage on my house, they not only seize my house, they can also seize all my personal possessions. So that's why I like apartment investing much more than I like single family. No questions yet? All right, I'm going to go to my favorite topic, which is a comparison between apartments and the stock market. So the really cool thing about the stock market is what? It's liquid. That means if I have my E-Trade account and I need cash tomorrow, I could go sell my stocks and I could get the money wired to my account by tomorrow. But the problem is I might have to sell it at a loss, but it's still liquid money, right? The big thing is you have no visibility to how the decisions are being made in the stock, and it's very unpredictable. And while the company could be really profitable, the stock price could still go down. And then you could have a company making, losses like a Tesla, the stock price could go up. And it could have everything to do with the political climate, war, a tsunami somewhere, all kinds of things can affect the price of your stock for which you have no understanding or control over. You could have fairly reasonable returns long term, but in many cases, it's more like a gamble and you have no tax advantage. So I know some people talk about what's called REIT, which is real estate investment funds. And those are still stocks that are traded with a ticker symbol in the stock market. And yes, you could invest smaller amounts of money in there, but you don't get all the tax advantages and the other visibility, et cetera, like you do with a single multifamily syndication. Every rich person I know had something to do with real estate. It's quite recession resistant. I had a property that we purchased as a general partner in 2019, and then we sold it in 2021. So most of that time frame, we were under COVID, right? I still had great collections. Our numbers, everything did so well. We like tripled investors' money in that time frame, right? So it was very, very recession resistant in the sense of people still need a place to live. They might stop traveling. You may not stay in a hotel, so all your travel industry could get affected. Your restaurants could close, but people need a place to live. So you're always going to have apartments are always going to be needed. All of us probably, no matter how wealthy we are today, at some point in our lives, spend some time in an apartment, at least in our early 20s, maybe we were in college, etc. So apartments will always be needed. And as long as you carefully vet the market, the operator, etc., and your passive investment in the real estate world, such as multifamily in the right market, could very well provide better risk-adjusted returns compared to the stock market, provided you're okay with it being illiquid, right? And the other thing I like about it is we get monthly reports, or when I'm a general partner, I send monthly reports on my deals. So you can look at the financials, the income statement, what the sponsors are doing to the property, is the business plan that they explained to you initially happening, et cetera. So you have a lot more visibility in what's actually going on. And if you live in the same area, right, like some of you are in Lubbock, many of you are here in the local Dallas area, you invest in a deal in Dallas, you can drive to the property, you can speak to the sponsors like Herb or Nikki or any of the others on the call, you can get to know the sponsor as well. And through your passive investment, you can learn more about the operation. So one day you can be the one to run a deal as well. So I highly recommend passive investing. That's how I learned to be a general partner. And so if anyone has any questions related to why you should passively invest, what's great about apartment investing, single versus multifamily, I can definitely go in more detail. What is a syndication, et cetera. But if there's no questions, I'm going to go to the next topic,
Yes.
which is the market outlook. Yeah.
I have a question here, and if it's not the right time for this question, just tell me. He says, can you elaborate on the tax benefits if passive investor is not a real estate professional? How important is it for the term loan in success of the deal?
So the benefit of a passive investment, like in this example that I had, I think I said you get 68% bonus depreciation as an example. So I think in this case, you would get a negative 68K K1 loss statement. So if you had any other gains or distributions from this particular deal or other investments you had, maybe to the tune of $4 or $5 or $10,000, you would not pay any taxes on that because it would get offset by the 68K. And let's say you couldn't use it in 2022, but in 2023, you or your spouse becomes qualified, then you could apply the balance that's still left over because you could carry it forward. But passive losses can be used to offset passive gains within the same category, even if you're not a qualified real estate professional. And whatever I say here, you know, I'm not a professional accountant. You want to run your scenario by your specific accountant, but that is my understanding.
Okay, I have a question.
Uh-huh.
And somebody asked me about you. What was the worst deal?
Uh-huh. So my worst deal as a passive investor, I actually made a Facebook post about my 3 worst passive deals. So anyone who wants to find me in Facebook or LinkedIn can learn more about that. But the first passive deal that was really one where I was worried about what's going to happen was one where it was a very heavy value add deal with a large portfolio, and the sponsor acquired it in fall of 2019, and then March 2020, COVID hit. It was in a market where the occupancy was also not super high. It was not Dallas-Fort Worth. And what happened was the sponsor, because everything was shutting down for COVID, but they owned a construction company, so they wanted to have business going for that construction company. Also, they might have had a loan where the lender requires you to spend the money that you said you would in doing your CapEx. So because of that, they spent large sums of money doing very extensive rehab to the tune of millions of dollars. This was a very large portfolio. So they made money as, you know, part of their construction company. They probably had to fill out some lender draw requests, but I think they could have toned it down. They could have done half as many rehab. They could have done it more slowly. But the problem was that delinquency kept going up. So in March 2020, COVID hits. April through June 2020, more and more rehabs get spent. Enormous, very elaborate upgrades get happen. July 2020, we get an email for a capital call. We all protest. We say, no, we can't do that. So then they change it to a member loan, not a capital call. So it becomes one tier higher of a loan. So that loan has to get paid first. So first the lender gets paid, then this extra loan gets paid before any of us get our money. So I was very upset. I was probably nagging that sponsor quite a bit. And so they ended up listing it for sale and I broke even. And then after that, a few months later, usually, you know, when you sell a property, you hold back some of the money because you don't know what bills could come from that. So they eventually sold it, kept the money, and then I got some more money to the tune of almost 10%. So I got my full principal back plus another 10% a few months after it was sold. So that's been my worst passive full cycle deal. I've got 3 other passive deals that are still in progress. The problem with one of them is that it was just a terrible market. And I trusted the sponsors, but I should have also vetted the market myself, and I didn't. So it's in a landlord unfriendly state, and the occupancy is low, and the sponsors did not live close by. So if you follow my Facebook or my LinkedIn post, this is exactly what I said, is all my bad deals have one thing in common. Nobody from the sponsorship team lives near the properties. And to me, that's a no-no. You need a boots on the ground who can visit the property. If we have an ice storm and I need to be at the property, I can be at all my properties in 30 minutes. So I don't invest in other people's deals where nobody lives in the town where the property is located. So none of the sponsors for months, I mean, you could say 3-4 months, nobody ever visited the property. Of course, the property management company is going to have a fun time. What do you think the on-site's going to do if nobody's checking on anything with them? You see the declining financials month after month, and I'm like, come on, guys, can't you fly out there? Can't you check on this, right? So that was bad. Then the third deal, which did badly so far, which hasn't sold. So this deal where it's located in this unfriendly market has not sold. The other deal that's doing poorly has not sold either, but it got hit by a hurricane. And so the insurance paid out much less than what's truly needed to fix it up. So the sponsor has put in their own money. So I appreciate that. But at the same time, I'm not confident of getting my money back. So no hurricane zone. I'm not a huge fan of Houston for that reason. I've had many Houston deals with mediocre performance, and I certainly don't want to say anything against Houston. It's just a personal preference to do everything that I could in Dallas or a market like Dallas. It's what I like. Any other questions?
No, fast. Let's go move on.
Okay, so I'm going to basically share with you the slides that I saw at an old capital presentation very recently by Greg Willett from IPA. So all these are IPA slides, and I'm focusing a little bit more on Dallas because that's my favorite market. That's what is my focus. And so here what you see is that apartment rent versus home payment. If you look at the very last right side, there is an $1,800 difference. So if you want to buy a house in Dallas, that's the difference versus renting. So renting is still very attractive in Dallas, very affordable. Your affordability gap is too high for people to go buy those single family homes because of these rising interest rates and just home prices having gone up in the last few years in Dallas. So it's still affordable to rent rather than buy. So this is a renter's market. The next thing is that domestic migration still favors the Sun Belt, with all your dark purple states being the most popular, and then the dark blue, and then these are your states that lost, like your Californias and your New York, etc. So Texas is still very popular, as is Florida, the Carolinas, Tennessee, etc. So you want to go where people are migrating, jobs are migrating, you have all the positive tailwinds that support your market. Dallas-Fort Worth apartment vacancy is at about 5.9% overall, with a difference between A, B versus C class. Again, you can influence it if you're a local like Herb and others like me. You know your little pockets that are really, really very favorable and are almost always fully occupied. Like I have properties in Irving, 2 properties in Irving, I have one in Carrollton, I have one in Garland. We're like at least 95% occupied all the time. And in our underwriting, we plan for a slightly higher vacancy anyway to have a little buffer. So you want to look at places that are, popular. So let's say you have a choice of going to 2 different restaurants. One is crowded and has a wait. You may have to wait 30, 40 minutes to dine. The other one's empty and you can walk in, and they're both right next to each other. Which restaurant are you going to pick? Put it in the chat box. Empty or crowded restaurant? Do you want to get immediate seating at that empty restaurant, or do you want to wait in line for that crowded restaurant? If you're awake, I would love to see a chat.
Come on, guys.
If you've already fallen asleep, I'm sorry. Depends on how hungry you are, huh? Okay. That's a good one. You might have to go have drinks at the bar or get some chips or some snack and kind of wait, because I think I'm going to pick the restaurant where the food is more likely fresh and what everybody wants to eat.
Yeah.
Most likely.
Yeah.
So this one is about the apartment price growth. That means, what is it costing me to buy this apartment complex? What has been trending in the last few years since, you see 2019 all the way to 2022. You look at Phoenix, that's on the very top. And then you look at New York in the very bottom. So you kind of want to avoid the very top and the very bottom. You want to be in the middle, and that's right where Dallas is. So in other words, its price growth is where you want it to be relative to other markets. And the 2023 outlook for multifamily, I don't know if you can see this very clearly. Let's see if I can do a slideshow. I don't know if that makes it bigger for you. Is that helpful?
Yep.
Okay, so what we see is the inventory growth, like how many more apartments are coming on board, and is it going to be too much? So at 2.7% and 25K in completion, it's a good number. We kind of got to watch it. But if there's too much, like an oversupply, that's probably going to affect your Class A, because what's a brand new apartment competing against, right? You want to charge more than $2,500 for a 1-bedroom. That's not really competition for your C and B class workforce housing, right? So you got to also look at what does new apartment build affect. And it's going to affect your A class a little bit more than it's going to affect B and C. You can't build more B and C. It's already existing, it's already built. And so that's the advantage of being in those classes. So these are some of the key takeaways that we heard from that presentation just a few days ago. Obviously, what the Fed does is going to play a very big role in the timing of what's going to happen. And here's my take on it. We can all hope and pray that interest rates are going to come down. But we've got to be prepared that they're not going to come down. Not going to come down even in 2024. A lot of us, I've heard wishful thinking that maybe in a year's time, interest rates will come down. Guess what? We can take advantage of it. If it's good news, it's good news for us. We're all ready for it. But it may not come down. You really need to look at your existing properties and say, if the interest rates stay where it is, what does it take for me to either refi or sell it? Is it going to be attractive for a buyer at this high interest rate? And if I refi now and I can't even get enough money to pay back my original principal, that's a problem. How do I solve that problem? Take a realistic look if you're in that situation. Work with some mentors and coaches. Face reality, because I don't think it's going to get sweeter or nicer or easier in a few months. It's important to face reality. Don't hide from that. The apartment pricing in North Texas, I do believe deals in bridge loans with a floating rate that are going to get into a problem with trying to pay these high mortgage payments. And if the bridge loan is expiring this year and you've got to either extend it, 3 + 1 + 1 is what a lot of loans have. If you've got to extend the loan or you've got to refi and it's not looking attractive, you're going to see some slightly distressed sales, meaning the sellers are not going to get the price that they could have gotten a year ago. So it's a little bit of a bargain or a discount time if you're a potential buyer or investor. Make sure that price per door for that class of property in that location is warranted, right? So that's where the local knowledge comes into play. So make sure you work with operators who know and understand their local market. If I had a deal in the Carolinas, you should be asking me, who's your local expert? Because that's not you, right? That's not me. I only know my Dallas market. So it's very important for you to make sure you find local experts and know what's a bargain, right? You need to know your pricing to know that it's a sale. Just because the store advertises a sale, oh, everything is 50% off. Well, what's my bottom line price? What am I going to pay for it? Oh, that's still overpriced. Well, you know that because you buy the item all the time. So it's the same thing, right?
I have a question in the chat box. Is 110% always have an exit strategy? So actually he's asking, what will be your exit strategy? Is this 110% from the apartment, from the deal?
Oh, from the example deal?
Yeah, for any deal, like your exiting strategy is going to be 110% return of investment, or?
No, not at all. It depends on what shape the deal is in, right? We don't know what shape the deal is in, how much trouble it's in, right? Let's look at this deal, right? This particular deal was an acquisition in 2022 on a 10-year fixed rate debt. So the mortgage payment remains unchanged for the first 5 years, which is interest only. So this is not a deal in distress. So whenever the sponsorship team has finished executing their business plan, which is I want her to do exterior paint or I want her to update 20 interiors, whatever that plan might be, whenever they finish executing that plan, the team comes together to make that decision. So in my specific case, there's 2 things I do on a quarterly basis. I take my quarterly financials and I send it to my lender who's looking at interest rates if I'm on a shopping mode. In this particular deal, I don't really need to send it to the lender because I have a great loan. But the other person I send it to is my listing broker who sold the property to me, because they know what the market is doing. They know what price I want. So let's say this was acquired for 25 million and I want to sell it for 32 million. So today, maybe the operating income that I have only supports a sale for 28 million. Then the seller listing broker is going to tell me, well, you just got the property last year. You need to work on it. You need to get the operating income to this much. You need to add other sources of income and value for the next buyer. This is where I need you to see. Deals are trading of this kind at this cap rate today. So they'll give me some feedback. So on a quarterly basis, I do that. But a deal that was only acquired last year, it's too soon for me to look at selling it. So I won't even shop this deal till the second half of 2024 at the earliest. if not longer. So every deal, it depends on the situation. My goal will be I must hit this IRR. And if I can't get 118% return, that's only in a 5-year period. If I can hit half of that in a 2-year period, I'll be glad to take it and exit the deal. But again, every deal is different and the exit strategy is different. And it's an ongoing process based on the interest rates and what's happening in the market. So today, if you want to sell a deal, it's more of a slightly distressed sale. If you can hold it for longer, wait and hold it longer. Like a deal like this, I have no reason to sell it. I may go the full 5 years, right, before I want to sell it. So it varies per deal.
Okay.
And then Sandy, we have another question. Why aren't you in the Houston market besides the fact that you don't have boots on the ground?
So I'm a control freak. I like to drive to all my properties. I'm like that Indian mom who knows everything that's in her pantry without having to look. So it's the same thing with my properties. I need to go get to my properties whenever I want. Houston's a 5-hour drive for me. That's too long. I can't plan a trip. I hop on my car, like let's say right now we're having a call about a property and it's in Carrollton and I want to go check something. I just shut it and I'm in my car as soon as my meeting's over. So last week, this is exactly what happened. It's in Irving. We had our call and they're like, oh, the painters are here. They're starting to paint the property. I'm like, oh my gosh, I got to see this. How gorgeous it's going to be when we do this exterior paint and my building is transforming before my eyes. So of course I rushed there. I couldn't wait to go see it, even though it was a bitter, cold, windy day. I took a very brief live video and I came back. So I have to see my properties whenever I want.
Good, very good. Let's move to the next slide.
Yeah, this was one of the slides I had where I wanted to just show you the opportunity cost. So let's just say that you pick cash or gold or crypto or other paper asset and notes, etc. Look at all their performance, right? How they've been doing. And do you get things like cash flow or equity appreciation or tax benefit? Is it a good inflation hedge? And are you using leverage, right? You look across the board at criteria like this, you'll find that all these alternative sources don't offer any of the benefits that multifamily does, which is why we say have at least a portion of your portfolio diversified. Don't put all your eggs into one basket. We're all taught to put all our money in the stock market. Take pieces of it, put it into real estate, real hard assets, money that you don't need right away, put it into real estate. It'll do better in the long term. And at least that's how we feel about it. That's why, for me, a large portion of my portfolio now is in multifamily. And of course, my biggest regret, I wish I had started sooner. And this is how you contact me to connect on LinkedIn. If you can scan that code, that's where you find me, or this is my website. And of course, Herb and all the wonderful organizers of this event know how to get a hold of me.
All right, that's good. We have one more question for you.
Okay.
All right, let me go. If we ran out, let me see. Okay, they want to know about if you have a limited fund after you have syndicated a couple of deals and out of the fund, how do you keep going?
If you have a limited fund, meaning you don't have enough money, or?
Correct. If you don't have a money after you have syndicated a couple of deals and out of the fund, how do you keep going?
You have to generate cash flow. If you have a W-2, if you have another source of income, or for me, the hidden source of money that I didn't realize I had was my retirement money from a previous employer. Now I took that, I rolled it into a self-directed IRA. You could also put it into a solo 401k. And so money that you never thought you had access to, you can use it to invest passively in someone else's deals. You can't invest it in your own deals. So how do you generate wealth more quickly? Well, whatever you think is the best source to get you money faster, but meets your risk profile. That's what you got to do. So an example would be, do you believe in your friend who's flipping a house down the street from you, and you can lend them some money as hard money or get involved in it? That could generate some cash. I don't know.
I have a question for Herb. Herb, if I'm going to ask her a question, can I be a winner of the gift?
No.
All right, guys. I have a question, Cynthia. which class of the apartment you preferred to do the due diligence? You preferred A class, you preferred B class, or C? I'm specifically talking about Dallas.
I like my B's and C's. I have a lot of C, and that's where the most value add potential is there. The biggest thing to remember is most people don't like to deal with deferred maintenance items. So between you and your contractors, before you make an offer on a property, you want to do your drive-by and figure out how much you'll have to spend. Like I did a drive-by of another property in Irving that's not far from my existing properties. The first thing I do is I drive by day and by night. So if you drive around even the parking lot of a subject property, one thing you'll figure out is, am I going to have to repair it because it's full of bumps? Because parking lot repairs are very expensive. And the second part of it is that your lender will require it. So you will not have a choice on repairing a parking lot. Same with the roof and leaks. It's especially good to drive by on a rainy day because then you know how the drainage looks, right? So that's a good one to check. You can also go ahead, like I go and introduce myself as a potential buyer. I speak nicely to the property manager. I see if I can inspect a vacant unit. Another thing they like to brag about is how well the property is doing. What does the subject property doing so well? And then they like to complain about, oh, if I could give you $100,000, what's the first thing you're going to fix? So they'll tell you the problems too. So those are really good ways to figure out your risk and how much you should plan on deferred maintenance. The biggest challenge with a C-class property is you don't know what repairs you'll have to do. But there's a standard list of about a dozen things you always want to check. The pipes, right? What kind of pipes they are, the foundation, the electricals. So there's a very nice checklist. Now, Omni Assessment, run by Brian Amos, does a fantastic job of due diligence. So watch some of their videos. That's a great way to look at what are the risks associated with a property. The older it is, the more people don't want to deal with it because they think it's too tedious for them. That's where you find good bargains. So every one of like the deal where we tripled people's money in a 27-month period, flat roof 1960s property, killed it, like did so well. You know, people love those properties. My Irving properties, my rent today is more than the pro forma that I projected to investors in October. I mean, we're talking 4 months. It's not long at all. So we're getting like really good rents depending on the location.
Correct. Because I think is people, passive investors are getting scared by the aging of the apartment. They really need to see and visit, because I visited one of the property. I love it. Frankly speaking, it's a community-based property. It's a very old 60s. We walk over there. We love it. We don't feel it's an old one. But again, the aging is like, and then investor, oh my God, I'm not going to invest. And I'm trying to educate these things to my passive investor. I think you really need to look at the property also, because how well is maintained. Right, even though it's old,
an opportunity for you.
It's an opportunity. Oh, yes.
Okay, let me give you an example. We bought a property in Irving C-class at the range of 120 a door. So let's say you can put a good 15K per door into it, and you bring it up to a 135 to 140 a door. You know what's the cost of another B-class or A-class apartment there? A-class is ridiculous. Cost of new construction, you're well over 200K. A-class is trying to sell for 250 a door. A B-class is trying to sell for 185 to 190 a door. I'm getting this for 120 a door. Okay, well, I could turn it in the interiors into a really nice palace, really spend some money on the lawn, the pool, everything, and still nowhere close to that. And it's the location, such a prime location. So you've got to look at the potential of a property. You've got to underwrite it for a higher CapEx. You've always got to have cash reserves, and then you've got to say, can I still do this? Is this too much work? Do I not want to bother, etc.?
Yeah.
The thing you cannot change is the crime. So if it's a high crime area, but a brand new property in South Dallas, I'm going to tell you no, thank you.
No, thanks.
But it's an old property, but it's in Irving, in a location in the streets that I know, I'm going to, say go for it. Carrollton, go for it, right? Good. So you need to know your locations.
Now it's time for draw, right, Gahar?
Do we have any
question, please? They can unmute and they can ask the question.
We don't want to leave with any questions, so please ask your questions while I pull up the lucky winner.
I don't have a question right this second, but one thing I want to say, this is Brooks of Isles Pinheiro. Sandhya, correct? Did I say your name right?
Yes,
Yeah.
Sandhya.
Sandhya. Oh, I love that. Sandhya in Spanish, that's watermelon. So
That's
beautiful. What I loved about your story, and I was a little late, my apologies, is when you were at MNATCon and you
Mhm.
advised you were at home raising your babies, having a job, taking care of your family, and you switched to multifamily. And I've been doing this, for a couple of years, and I never see women represented or those in W-2s. And your story was so inspiring and so memorable that you went, and for everybody, I go, you have to hear Sandhya's story. She was somebody who was taking care of her babies and her family, and she migrated to multifamily and didn't have a real estate license. And so many people have success that have been in real estate for years. So I just want to tell you that was so inspiring. I
Thank you.
love your back end story. I don't know if you shared that part of your story, but it was absolutely fabulous. And I have actually shared that story with many people. So kudos to you and keep kicking ass.
Thank
did
you.
it.
Yeah, I have no real
Way to
estate
go.
background prior to this. Thank you. So yeah,
Yes.
4.25 years ago. So 4 years and 3 months ago, I got in straight to multifamily and I skipped single family, and I've got no real estate background prior to that.
All right, let's go spin it.
Okay, you ready for touch the button, pull the lever?
Yep,
Okay, here it goes. Can you guys see it spinning?
is it
Yay.
spinning on, is it spinning
Yes,
on
it's
the
spinning.
our side? But I think
Yeah,
the screen
yeah.
sharing is a little bit slow, so trust me, it's spinning.
Ooh, we have a winner.
Non-repeat.
Anon, are you on the call?
Just want to
Yes,
tell you
I'm
that-
here. I can't believe this is the
There you
first time in
go.
50 years I've won anything.
You know, buy a lotto ticket today.
Oh my
Awesome,
God, I
awesome.
should have bought a lotto.
This is a $25 gift card. We
All
were
right.
excited to give a $20 Starbucks gift card. And when I went online to purchase one so I could email it to you instantly after this meeting, they had
Okay.
25 and smaller, but they didn't have the 20. So you get a $5 card today.
You will get
Uh,
an email, Adnan, so you can print it out and use in Starbucks with your kids.
All right. Wonderful.
Yeah, just
Let me say
tell
this,
your family-
Sandhya, your presentation was awesome. And your energy was even better.
Glad to help. Anytime, if I to find me through the organizers, you need to get a hold of me for any questions.
So I just want to let you guys know the next speaker next week on February 27 is Sean Griffin. Sean is a very another experienced multifamily syndicator and operator. Please do not miss that event. He's a wonderful guy, and he's gonna show you his due diligence for recent closing for Treetop and how the Treetop is doing right now. All right, guys.
That's his picture up on the screen, Sean, and I'll leave this picture up a minute. So
Yeah, Sean's right now in Antarctica, so hopefully he'll be back in time to do this pitch next week.
Yes, he said that he will be.
Yeah.
All right.
Thank you for the opportunity.
Thank you
Have a
very
nice
much guys for
Sandhya.
coming.
Bye.
thank you all for
Thank you
coming
all.
out. We'll
Thank you all
share
for
these-
joining. We look forward to next week. Seeing you all next
Thank
week.
you.
Thank you all. Good night.
Thank
Bye.
you. Good night.
Bye.
Bye.